Money never sleeps, pal.
So, morning, Gareth. It's the end of the first full week of the new year of 2024. Friday morning, 12th of January. Feels like we've been going at this a bit longer than just the first full week, but quite a few things going on in the market. And just thought we'd maybe touch on a few macro factors driving financial markets and then maybe talk about a few companies. So I'd say the broad highlights from a macro perspective would be that inflation is probably proving stickier and more difficult to control than people thought. We've got rising tensions in the Middle East. Having said that, oil prices are not really spiking. They're going up a bit, but they're still, Brent's whatever it is, below $80 a barrel still. We've had a bit of a shenanigans around Bitcoin and whether Bitcoin should have an approved ETF, which it now does. It has 11 of them. Does it matter? We've had UK GDP data today, which indicates we're going to avoid a technical recession for 2023. So yet again, we get headlines that the UK economy is better than expected. Who'd have thought? And I guess the overriding question in my mind about where we are now compared with where we left off in 2023 is, what was it that spooked the Fed? It doesn't seem like it's dramatically lower inflation or the risk of significant deflation in the short term, at least. So what is it that got them so jumpy and made the pivot that they did at the back end of last year?
And do you think it's that they know something that we don't? Or do you think it's just a sort of a general perspective thing? Or do you think there's something specific that might be worrying them?
Well, I think there are a number of explanations. You know, the cynics out there will say Jay Powell knows there's a presidential election in 2024, and he's doing his bit to get Biden re-elected. I don't actually believe that, but it's tempting. But I think if they can see something we can't see, it's probably to do with the US banking system. So I think in terms of some credit event, some rerun of the regional banking crisis we had February, March last year, clearly the Fed has oversight of, it is the Federal Reserve of the US banking system. It should at least know what's going on. So if it can see something we can't see, it's probably relating to what's going on inside the banking system in the US. And I think there's this, well, I don't think we know there is this lending cliff where particularly commercial real estate loans in the US need to be refinanced in some shape or form at much higher rates. So as we go through the current year. So yeah, that's what I think it might be if there is anything. And as I think we've discussed before, the markets, we're entering this year with markets pricing in significant cuts to interest rates and thinking it's good news. But history tells you that if you get a period of sharply declining interest rates, that's usually accompanied with something else that's gone wrong. So without wanting to pour too much cold water on the sort of market euphoria of recent weeks, one has to be mindful that things can and do go wrong.
Yeah. In order to justify those lower rates, there probably needs to be some pain, at least in parts of the economy. I think that's probably right. But that's a good way to move on to talking about the UK market and some of the company news that we've had. It feels like Christmas has generally been okay.
Yeah, looks like it. We've had trading updates from a number of food retailers. Interesting that probably the clearest retail winner in the UK, particularly of the larger names, has been Marks and Spencer, and had what appeared to be perfectly good update of the Christmas trading, both in food and in clothing.
Yeah.
But the share price went down. So, obviously indicative that the market is in a much more bullish frame of mind and expectations have been set for a broadish recovery in the current period, which is in marked contrast to where we were this time last year.
Yeah, and as you say, it's also in contrast to what the bond markets are thinking might be happening in terms of expecting lower interest rates because of ongoing pressure. So if maybe the equity markets are being a little bit optimistic about things.
Yes. Yeah. I mean, we all think that lower inflation is a good thing, but deflation is probably, in an indebted economy, deflation is a bigger risk than inflation.
Real problem. Yeah.
So I thought it was very interesting what the guys at Ruffer have been saying. In the last few days, they've been reminding people that although we're all expecting and discounting lower rates, they haven't happened yet. And the only organisation, the only institution that can seem to be quite happy with, say, 5% or 5.5% interest rates are a government organisation. Everyone else seems to struggle at that level. So the longer we're at this level, the more painful it might become. So,
Yeah.
yeah.
No, that's true. Although some signs of light from the UK house builders and other trading updates have been generally at least in line with what people were saying towards the back end of last year.
Yes. Of the larger ones, Persimmon and Vistry have both indicated improved reservations year on year, and that the cost of building a house is continuing to moderate. So, having had an awful 12 months, the UK housing market has not collapsed, which I know Alistair Stewart has been writing about in his work, saying that for over a year now that he didn't think the thesis that the UK housing market was about to collapse, and so far so good. And with a highly competitive mortgage market, mortgage rates have gone down. Although they're not waiting for policy rates, they're already moving mortgage rates down because long-term interest rates have gone down. So if you're a first-time buyer and you've still got a job, real wages are going up because inflation's coming down and wage settlements are running at a higher level than retail inflation at the moment. For house builders, things are better. Having said that, housing transactions are still very low. So I think the thing one needs to be mindful of is at what point do housing transactions pick up? So people have not been moving house in the last 12 months, and they haven't done so to date. We're still running along the bottom. And that's impacted. We had a profits warning from a little company I follow called Marks Electrical, which is an upmarket competitor to AO World, delivers household goods. I've interviewed Mark Smithson, who's the founder and chief executive of Marks Electrical. He's a real raw entrepreneur and someone you just want to back. But he had to warn that while revenue was in line with where they'd guided, the cost of delivery, the cost of running the business at such high service levels. I mean, this is an industry where you can, if your dishwasher breaks down, they'll deliver and install one the following day anywhere in the country. So this is not an easy business to manage. The logistics are very challenging. But the reality is he's taking market share, he's growing his top line, but his profits have been substantially impacted by the inability to contain costs and gross margins. So,
yeah, but as you say, I mean, if the volumes of housing transactions start to increase, that's when people buy white goods. So hopefully that might be a medium-term recovery play for them.
Yeah, I don't own any shares. I don't really feel I got skin in the game on this one, other than having got to know Mark quite well and admiring how he runs his business. But yeah, it's definitely gone up in my estimation, the way he wrote that update. And they would be a beneficiary, as other retailers would be, particularly of household products, if transactions start to pick up during the year. So it's definitely something I've been keeping an eye on.
Sounds good. And then more broadly, I guess, looking at other sectors, Sosander, with their foray into the physical store market, they've struggled a bit with there, but still more to go from that one over time with a reasonable update just this week.
Yeah. Julie and Ali, who are the co-CEOs of Sosander, were the people who I interviewed them on a podcast about 18 months or so ago, and they completely changed my mind on whether joint CEOs ever work in a business, because it might be a one-off, but in their case, it definitely does. And these are not people to underestimate, in my opinion. But again, like with Mark Smithson, they've chosen to operate in what is a very challenging business. I mean, I think most people will be aware of the fact that online clothing retail has been a bit of a nightmare, or more since the end of lockdown. People like ASOS and Boohoo really struggled. And Sosander's target market is slightly older demographic. It's female fashion, but the shares were hit quite sharply during the course of 2023, not because of a slowdown in the business, but because of the market got spooked by Julie and Ali's ambitious plans, and those included opening stores in the UK for the first time and expanding overseas. So these ladies are not happy just to be a small niche player in the UK. They make it quite clear when you talk to them, they want to be a recognised household name. They want to be 100+ million revenue business with 10% operating margins. And to do that, they feel very strongly, and I wouldn't be prepared to bet against them, that they need to be more multi-channel. And keeping an eye on it, but tough business. You've got to move a lot of product at quite low margin, and you've got to avoid returns, which they seem to be doing successfully.
Yeah.
But there's a lot of moving parts there in what is still quite a small business.
Yeah, going okay at the moment. So yeah,
Yeah.
and I suppose the only other couple of stocks that I had in mind, one was Xaar, a company that we know pretty well.
Yeah.
Who've said that the end of calendar 2023 was in line with their expectations they set back only in November, but at least they ended the year as planned and slightly ahead in terms of cash, and there's no change to their outlook for 2024.
Yeah, I think that's an interesting one, I think, isn't it? Because you know better than I, but I think China's quite an important market for them.
It is, and we talked the other day about the possibility of a sort of a China recovery and what that might mean for commodity prices or inflation or just general sort of global demand. But yes, certainly Xaar had hoped to see a China recovery in 2023, didn't really come through, and that hurt them. But there are some signs that could start to show through in 2024.
Yeah.
And yeah, I think more broadly, I think what we've seen generally this week is a lot of companies saying that things haven't dramatically worsened over the last few weeks or through the sort of the year-end trading period or Christmas for the retailers and people for which Christmas is an important season, has gone not too badly. So feels like at least a reasonable start to 2024, albeit with the caveats that, as you mentioned, with the things that people like Ruff are highlighting, that there is clearly risk to this sort of rose-tinted view that we'll have lower interest rates but nothing else to worry about.
Yeah, I mean, I don't want to come across all too bearish because, I mean, if you cast your mind back a year ago and I'd said to you, well, 2023, we're going to have a US banking crisis and 5.5% interest rates, where do you think the equity market would end up overall? Global equity markets, I think 90% of people would say, well, down.
Yeah.
The markets can be very resilient.
Okay, that's great. I think it's a great place to end, and hopefully we'll get more, at least not bad news, but more potentially good news as more companies report or give us trading updates as we go further into January and then into the rest of Q1.
Okay, one last question. Now there are Bitcoin ETFs, you'll be able to allocate the Evans portfolio towards Bitcoin, no doubt.
Yeah. Someone I follow on LinkedIn pointed out the fact that the US regulator had prevented people from investing way earlier in the extraordinary upside that Bitcoin has seen so far. And yeah, the cynic in me.
How grateful we should be for the SEC to save us from investing in Bitcoin in 2013 when the ETFs were first proposed. Because the Bitcoin's only gone up 90-fold since then.
Yes. Yeah, they saved me from investing at that point. So I'm not sure. Now I'm still not quite sure today's the right time to wade in. But no, certainly watching it with interest, and it's becoming definitely more mainstream.
Yeah, you could argue this is the top, I guess, on that basis. But I think the SEC have done what they've done through gritted teeth. And I think they made that quite clear. But I think it's fascinating. Still rather peripheral, but let's see.
Yeah, we'll see what happens.
Okay. All right.
Thanks very much.
Good to chat.
Okay. Talk to you soon.
Bye.
Brought to you by Progressive Equity.